introduce Nonie. Some of you might already know her. She's very active in the energy, and she started off in her career in the communication space with Xerox. And with Sprint, she brought the first internet node and cell phone network to Hawaii. She's been involved in major state infrastructure projects, advancing broadband and public education. In 2007, she was part of the Hawaii Clean Energy Initiative, helping bring large-scale wind, solar, battery, biofuel, and rooftop solar onto the grid. She was actively involved in major policy reforms, such as community solar, net negative greenhouse gas goals, renewable fuels, EV and hydrogen incentives. Last year, she worked on passage of Act 183 to allow private financing for public benefit projects for renewable and resiliency projects, which is what she wants to talk to us about today. Nonie, if there's anything to add.
Thank you, Jerry. Thanks for the nice introduction. Nice to see you all. I think I know most of you. I'm located on Oahu, and the latest policy issue that I'm working on is something called CPACE, which is a commercial property assessed clean energy and resiliency financing type of tool. So last year I worked with Gwen Yamamoto-Lau, who some of you may know. She is with the HGIA, Hawaii Green Infrastructure Authority, and that's attached to DBED. And she apologizes for not being able to be here today, but she's getting ready for her grandbaby's first luau on Big Island, actually. So we worked very, very hard last year to pass this initiative. And if you don't mind, I will share a brief PowerPoint, which can kind of give you the highlights of what this initiative is. It's a new form of financing, new for Hawaii. It's not new across the mainland, and I will show you what I mean. So we call it CPACE for short. It's Commercial Property Assessed Clean Energy and Resiliency Financing Program. And what exactly is CPACE? So last year, Act 183 authorized the counties to levy a non-ad valorem special assessment to allow a voluntary assessment on commercial properties to finance qualified improvements attached to the property. In the mainland, some areas only cover renewable energy. In Hawaii, Gwen had the foresight to also include resiliency type projects, and I'll show you some examples of that. So the program utilizes private capital. There's no public funds, and there's no funding or resources that are required by the county. What this tax looks like or mirrors is a property tax, but the property tax remains in first position. It does not affect the property tax at all. And the projects that are able to be financed serve a public benefit. And this is available for new and existing commercial properties. And I'll get into what a commercial property definition is for the purposes of this statute. The key is that it's serviced by HGIA or Gwen's group. And that's so that there's not going to be any resources that are necessary for the county to bill it or to collect it. But the county does have to authorize this program through an ordinance. Okay, are you guys seeing a map on the right-hand side?
So you mean it has to go through county council?
It has to go through county council and get approval by council and get approval by the mayor. Do you see a slide background of CPACE? Are you seeing that slide?
Yes.
Okay, great. Okay, great. All right, so how did CPACE come into being? Several years ago, the Department of Energy found that there was a financing gap for buildings that wanted to improve energy efficiency and lower its operating cost. Typically, when properties wanted to install, let's say, better lighting or HVAC, they would have to finance it through a very short-term financing at a very high rate. And so they created this tool called CPACE, and what it led to is that CPACE financing then became available through the private sector. Currently, there are 36 states and the District of Columbia. You'll see on the map in blue. We were one of the last states to adopt this, but unless each county or unless a county says yes, then the blue will turn green. So the county must authorize it. Otherwise, this program is not available in Hawaii. So far, there's been $2.5 billion in CPACE financing, and 2,500 properties have been financed. And I'll show you some of the projects that we do have, some shovel-ready projects that are wanting to take advantage of this. I think most of you know DBED. It's attached to the HGIA is attached to DBED. Their original objective was to make clean energy accessible and affordable to underserved ratepayers. So one of the things they do is they have innovative financing, and they are able to finance through the utility bill using private capital, renewable energy. That's one of their programs. Another one of their programs also have to do with financing is to increase access to capital for small businesses. And so this would be a third type of program that they offer. I think one of the main things is that it's a voluntary assessment. So the commercial building owner would say, I want to have this assessment attached to my commercial property and provide access to capital at lower risk to the lenders, which then allows for lower risk or lower interest rates to the commercial entity. CPACE loans may be amortized up to a useful life of the equipment, which, for instance, on solar battery can be typically 25 to 30 years, as compared to shorter terms on conventional equipment, let's say 5 to 8 years. And with that longer amortization, lower interest rate, of course, what it does help to do is improve cash flow. And that's good not just for the borrower, but for the first mortgager, for the county, because then they can afford to pay all the notes that are due. What is very nice is 100% of the project cost is financed. There's no equity required of the borrower, and this includes any direct costs as well as indirect costs. So no money down. It's non-accelerating, just like a property tax. If, let's say, the property owner becomes delinquent, only the current payments are due and not the balance of the loan. So let's say they take out $1 million to put PV on, and they are delinquent for $10,000, only the $10,000 would be gone after, just like a property tax. You don't go after future values or future notes. And there's no recourse. So there's actually no personal guarantee that's required. Again, because the risk is low, it's attached to the property. And when the property is sold, the CPACE is transferable to the new owner. This separate capital stack does not require the refinance of a first or second mortgage. So it's especially in today's rates market where people don't want to have to refinance. This allows for a third financing tool for them to increase their property value, put resiliency projects onto the property. So here kind of explains the access to this new capital. As you go down the triangle, the risk is very low for property tax. And CPACE sits right under the property tax. So you have low risk. When you have low risk, you can be provided low interest rates. As you go down the triangle, of course, you know, first mortgage, interest rates get a little bit higher, second mortgage higher, and then equipment. course, as the highest. Along with the low risk, low interest rates, that allows for long amortization versus equipment short amortization. This shows you a typical chart comparing the traditional traditional financing to a CPACE financing. So you have equity into your property. You would come in with a first mortgage of 65%, and whatever can't be stuffed into that first mortgage, typically the owner will have to take out mezzanine debt, which is, of course, one of the highest interest rates. However, with CPACE, again, you might have equity. You can borrow a lower amount for your first mortgage, and now you can borrow a higher amount, which qualifies for CPACE at a lower interest rate. So the net weighted average of your building is going to be less utilizing CPACE. These are the types of projects. This is not all encompassing, but it gives you a general idea of some of the things that can be financed. As long as it's attached to the property and it has something to do with clean energy or resiliency or sustainability, then the CPACE lenders and the banks would be agreeable to finance it. So for energy efficiency, a lot of times, these pay for itself, right? You can save on your energy cost when you install these types of efficiency measures. We're getting a lot of hotels who are interested, especially with the water issues, to reuse their gray water. For instance, utilize it for landscaping. In renewable energy, getting a lot of interest for EV chargers. Of course, the solar and the batteries, water heaters for large hotels, cogeneration. Cesspool conversions. There are still commercial cesspools that have not converted. They were supposed to convert in 2004, and now they're facing EPA fines. When this statute was first being considered, one of the big drivers was to try to get cesspool conversions, which we have over 80,000 residential cesspools. So CPACE comes into, or PACE comes in two flavors. One is residential, one is commercial. The original bill included residential. However, as you saw, the CPACE loan takes first lien over the first mortgage, and so the local banks felt that they weren't ready to, it's such a new program, they weren't ready to take this second position under the CPACE. On the mainland, they do it in some areas, but they were ready to enable this for commercial properties. And what we did was we all sat around a table, and they were ready to do it because they insisted on first right of refusal. So they are allowed to say no to the borrower if the borrower wants to have a CPACE loan. If for any reason the bank does not want to give up first position, they can say no. But they can establish their own CPACE program, and they can say no, but I will allow you to utilize CPACE through my own bank. Typically on the mainland or over here, most of the commercial properties are really not financed through the local banks. However, the CPACE bankers and first mortgage bankers, first mortgage institutions, the large ones, they all see it as a win-win. If the property owner is going to improve their building and lower their net operating costs, they see no problem in allowing a CPACE loan to ride under the property tax. A big one here on Oahu, not so sure if it's as big a conversation on your island, but we had the Marco Polo, which had some tragic deaths. And so the city council here are trying to mandate fire sprinkler conversions, which are very, very expensive, just like cesspool conversions. CPACE can finance fire sprinkler conversions. And then we have your typical natural disaster, hurricane clips, seismic retrofits, weatherproofing foundation, window improvements. And a lot of people are excited about this one. The way that we built the statute is that it can qualify for any agricultural entity on agricultural land can qualify for a CPACE loan. And they can finance wells, pumps, processing centers, refrigeration. We know that there's a lot of food safety issues where now they have to have processing centers, and they spend a lot of money to refrigerate, to process their produce, for instance, before it goes to market. Any questions on the types of projects that you can finance?
I have a question, if that's okay.
Yeah.
When you say commercial, does that include or in any way exclude industrial activities?
It includes.
Okay.
So
all right.
That's a good lead in. Here's my next slide.
Okay.
So for purposes of the statute and the ordinance, commercial is defined pretty loosely. It doesn't change the zoning or the classification in the property tax system. That totally separate. All that this definition includes is for this particular program. So it can include affordable and workforce housing. Anything over 5-unit, multi-unit dwellings. So that can be very, very good for, let's say, senior housing, affordable housing. It can include hotels. And remember, this is for new and existing. Hospitals, healthcare, offices, retail malls, agricultural facilities, and nonprofits. So schools, social welfare, cultural institutions. I was thinking, this might be something that, for instance, the KIAA area might want to consider utilizing as they, I was involved with KIAA about 5 years ago where they wanted to improve their buildings, right? So they can be using a CPACE loan to do that.
Nonie, Riley,
Yes.
what
Yes,
about
Riley.
home-based businesses?
It cannot be a residential property, so it has to be a 5-unit multi-dwelling. I mean, if the home base is considered a commercial building, then potentially.
Oh, hi, Nonie.
Yes.
Peter here. Hi. So I see all the lines connect everything. I see residential. There's no line to it. So residential is not included. What about a residential on ag land for the purpose of cesspool replacement?
I believe that would qualify because agricultural facilities does have its own category. So if it was farm employees housing on an ag lot, what I've been told is it can qualify.
Okay. Oh, well, yeah, I'll look into it for the details. Thank you.
Yes. So what are the benefits? Yes.
Municipalities too will be.
I'm sorry, say that again, Jerry.
Municipalities, county.
Well, yeah, see, but they don't pay property tax. So this is a lien attached to a property tax.
Oh, it's property
so
tax.
So it's not for the state, it's not for the county, it's for anybody who pays property tax because it's attached to the property
district
tax.
Improvement.
It's like a district improvement assessment.
So Nonie, and I can wait until the end, but one question that I had was, this is a voluntary assessment that is, does that assessment for the entities that want to participate and get that assessment, does that mean an additional payment, say the equivalent, I mean, in terms of a cash payment that you would pay in addition to your property taxes?
Correct. So if you borrow $1 million at 7%, for instance, it would be the monthly payment, or actually twice a year payment, right?
Okay, but that assessment doesn't if you don't borrow money, you're not paying anything extra.
Correct.
Okay,
Right.
got it. Okay, so
Only if you volunteer,
got it.
and
Okay.
and you're getting something back from it. You're buying something, right? You're buying an improvement.
Okay.
You're buying panels. You're changing out your windows. Right.
Nonie, Riley, I got to drop off, but
Okay.
we'll set up another meeting. Yeah.
Thank you, Riley. Appreciate
Okay.
it.
All right.
Yeah, I'll
Bye.
follow up with you. Okay. Okay, so why do people want to voluntarily put this assessment? Because oftentimes it's going to improve their cash flow, where the energy savings on efficiency is greater than the payments. Or sometimes, like the cesspools, they're facing daily fines, $1,000 fines, and so they need a way to stop the fines, again, to improve their cash flow. As their NOI increases, of course, the property value increases. And it's a completely separate capital stack, does not require you to refinance your first or second mortgage. On new construction, the CPACE can typically cover about 15 to 35% of your total project costs. So imagine if you're building an affordable housing development. You can stuff a lot of things into a CPACE. Your windows, your water faucets, your toilets, your showers, anything that is efficient, energy efficient. If you're going to be putting, PV panels to cover the common areas, typically it's going to be 15 to 35% of your total project costs. If it's a retrofit on an existing building, it's typically they will finance 100% of the project costs, as well as the indirect costs. So any consultants, your architect, etc., no funding out of pocket for you. Like we said, for energy efficiency, it mitigates the rising cost of energy, and it makes resiliency measures and advanced technologies now very achievable for owners. As a property owner, let's say I have tenants, whatever the lease says, of course, the debt and the savings can flow through to the tenants or the condo owners. And what that does, it increases the marketability to get tenants, because they'll experience a lower cost of energy, better aesthetics, greater comfort. With hurricane and safety hardening, it will also lower your insurance costs. So the example that I gave you for the condos that don't have fire sprinklers, they're experiencing an exorbitantly high cost of insurance now. So if they were to put in the fire sprinklers, then that could bring their insurance costs down. And what's really nice is several years into this, there have been 0 foreclosures nationwide. Again, because it's voluntary, and again, I mean, it's such a great benefit to the building and to the cash flow. So we're presenting this to all of the counties on all of the islands. We've presented it to several council members on your island, and they're all very excited about it. See, these are some of the benefits from the county's perspective. There's absolutely no investment by the county. It's not an obligation of the state or the county. It's all private financing. Unlocking this special assessment can help private capital achieve public good. The private investment can upgrade existing assets with energy efficiency, eligible upgrades to lower operating costs. The resiliency measures will improve the durability of the buildings. As more and more people improve the buildings, then the county can really consider higher efficiency standards. I know that in hearings that I've gone to, there's always a great balance between increasing efficiency standards, but the cost to the building owner and how it increases, for instance, affordable housing if you force them to put in higher standards. The increase in commercial property values eventually may increase their property tax over time. No burden to the county to implement HGIA will independently administer the program and service the CPACE loans. So the property owner would get their property tax from the county. They would get a CPACE loan invoice from HGIA. They would pay HGIA their CPACE loan, and they would pay the county their property tax. If for some reason, again, as I said, there's been no foreclosures on the mainland, but if for some reason there has to be a foreclosure, the expenses to foreclose, the county does have to foreclose, but the expenses would be paid by private capital, whoever is holding the note. So all the financial risk is on the capital provider. I think typically what you're going to see, however, because the note on the CPACE loan is so small, let's say, $10,000 that's due against a $10 million first mortgage, you're going to see the first mortgager take care of that CPACE note if something were to go wrong. However, if a commercial property owner paid only their CPACE note and not their property tax, and HGIA collected it, HGIA would have to remit that property tax, the amount that they collected, back to the property tax. So property tax will always get first lien. So there's no risk to the county. Banks can also take advantage of this. So there are a number of lenders that have specialized in CPACE, and who I represent is a nonprofit who has members that are CPACE lenders, who has banks in this nonprofit as members, as well as HGIA lookalikes across the nation, the people who are actually administering the CPACE loan. So as you may recall, what I said was the CPACE, when you go out and you ask for a CPACE, you have to go back to your first mortgage and second mortgage holder. And you have to say, can I take out this commercial property loan, the CPACE loan, and consent has to be given, but consent may be withheld for any reason at all. They may not like the way that the deal is structured, or they just may say, well, no, but I can do it myself. Come to my bank, and we have this CPACE. And so it doesn't replace any major construction lending or new development by the local banks. So the CPACE Nation, which is a nonprofit, had done a study when we passed the bill, and they said, well, what's the benefit, the economic benefit to the state? What they estimated is that if only 15% of the commercial property owners utilize CPACE, it would create over 12,000 jobs, 2 billion of water saved, and 2 million fewer tons of carbon emitted. And there are some shovel-ready projects that are waiting for CPACE to happen in every county. We've got fire suppression system installation for condo, a mixed-use office, or turning retail to a multifamily project, senior community living project, hotel renovations, a new hotel, a couple new hotels are waiting to do this, a housing project, a large capacity cesspool remediation. So just to give you an example, there's a property owner who has a cesspool and would need $100,000 to convert their cesspool to a septic tank. They ran behind in their bills during COVID, so they can't afford the $100,000. So what they would typically do, again, because they're experiencing fines from the EPA, is they would have to refinance their first mortgage, or take out a second mortgage, or refinance the first and second mortgage. And at today's interest rates, that's going to put that owner underwater. So instead of doing that, a CPACE can sit in terms of a third loan just to finance that $100,000. So instead of refinancing her $500,000 into a $600,000 loan, she could keep her $500,000 and then simply take out a $100,000 loan. So what would happen if the county wanted to do this? They must authorize HGIA to administer CPACE via an MOU. There is a draft ordinance that HGIA has created that is in line with statute, as well as with county processes and county existing statutes. So there is already a draft. This draft was done by HGIA's outside counsel, which also happens to be the bond council for your county. And then, of course, the county has to adopt it to establish it. So I'll stop there, and maybe we can go for questions.
I have another question. It's a little bit more specific. We are potentially planning to build a tier 4 hyperscale data center in Hawaii. Now, it's a commercial activity. However, it's not directly benefiting the public. And of course, because data centers use a lot of electricity, we're providing our own. It has to be efficient. Would something like that qualify for any of this type of financing?
Absolutely. Let me clarify. The entity or the building itself does not have to provide a public purpose. The resiliency measures for the renewable energy in and of itself is a public purpose. So
Perfect.
the entity of the business does not have to, right? So it could be a retail mall and they want to install EV chargers. The EV chargers are a public benefit, right? Or energy efficiency because you're saving electricity for the greater good. You're reducing carbon. That's a public benefit.
Okay, excellent. And is there an amount limit on the funds that are available?
No, there's no amount limit.
This
Because these are private financiers. The amount limit would be the financier taking a look at what qualifies and what
Sure.
could qualify under CPACE loan, right? And your ability to pay the note. So there's not like we have $20 million in funds. I mean, what we're talking about are entities who are trying to, for instance, create a $200,000 housing unit and $200 million housing unit. We've got a developer who has 2 projects who wants to develop multi-unit housing on Maui and on the Big Island. Of those 200 million, he's saying, I have 35 million that could qualify for CPACE. And so he's going to the local banks here and he's saying, I'll borrow from you, but you're going to have to allow me to utilize a CPACE loan because otherwise I'm not going to build the projects because I can't afford to with a conventional mortgage or with the equity that you want me to pay. So it replaces this mezzanine debt, which is very expensive debt for a builder.
And this is not, if I understand correctly, this is not limited to just local lenders. This is out-of-state lenders as well?
Absolutely. So the out-of-state lenders know how to do this. They've been doing it nationwide. They're very, very focused on Hawaii. That's why they're asking Gwen and myself, can you unlock the counties and allow this to happen? Because they have these shovel-ready projects, developers from here and from the mainland going to these mainland CPACE lenders saying, can I use CPACE? But they can't do it unless the counties open it up. And so right now we have the attention of these private lenders. However, they go where the opportunities are. So we're trying to make a big push so that they don't lose the momentum of watching Hawaii. They wanted it to open up late last year, but Gwen had to, go through a series of meetings and get all the documents ready. She has presented to the directors of finance. Is it Diana Sacco over here on Big Island? Who very much wants this to happen now. We've presented to Heather Kimball, who is also very, very excited to make this happen. So, and we're doing our rounds of presenting to a lot of the other council members. We have not experienced any negative comments at all. They all see this as a win-win for the county, for the commercial property owners.
Nonie, I have a couple of questions. So the first one is related to the sources of capital. So obviously it's private, but is there any guidance on where or what the general sources are for this money?
What I'm told, I don't know where all the sources are, but a lot of pension funds.
Okay.
So union pension funds are funding this.
Okay.
But also, as an example, one of the largest CPACE providers in California is a bank, a local bank. So they've seen the opportunity. They say, hey, we want to play because this is a whole new source of income for us, right? And when Gwen first thought through this, the banks were flush with cash because of COVID. And so she thought this was a way of trying to churn their money into another tool for them. So we have, probably half the banks in Hawaii are saying, I want to do this. Let's open this up. I want to do this. The other half the banks may see it as competition if they don't want to get into this business, right? And realize that the banks, the local banks, do probably 90% of our residential mortgages, right? And so they don't want to let go of that type of business. Yeah. So, and that's why we peeled residential off.
Yeah, I imagine insurance companies as well. It's where a lot of commercial lending happens. I have another question related to. So this is our hypothetical, right? So Ray had raised this scenario where there's a data center that needs to be built. There are all these investments that are required, some of which might qualify. And you mentioned that renewable energy systems are potentially in scope. So what if there were an entity that was focused on generating or creating fuel, and they need to install industrial scale green energy generation or production? Would something like that qualify, or would it only be the investments in the facility itself that would that relate to the categories that you mentioned earlier: energy efficiency, energy for the facility, that sort of thing?
We probably have to have a lender get on the line to for you to fully describe the scenario. But for instance, the renewable fuel manufacturer producer probably is a commercial entity. And so whatever they are utilizing the equipment to make the renewable fuel could possibly be financed through CPACE, right? Mm-hmm. It has to be, the equipment has to be part of that facility. Just as PV would be part of the facility of the data center. Okay. Or if the data center is using cogeneration, the cogeneration can be financed. I don't know if the fuel in the cogeneration can be financed, but if the entity is making fuel at a different commercial facility, then maybe those types of equipment could be financed.
So, Nonie, just to kind of clarify within the context of Noel's current question. So, if I understand, Noel, you're talking about essentially a greenfield construction versus an addition or modification to an existing facility. So it would be to create something completely new on raw land as a commercial venture.
Mm-hmm. Mm-hmm.
Yeah, and based on what Nonie had mentioned earlier, new construction, right? Certain components or percentage of that might qualify for the CPACE funding. So it depends on what exactly those components are, and some of it might be covered.
Correct. So let's say I'm just throwing this out there. I don't know for sure. We'd have to ask a lender. But if you're putting an electrolyzer, right, in your building to create hydrogen, that could potentially be covered.
Yep. Awesome.
Can I ask Noel?
Yeah.
Noel, how does this differ from sustainable partners?
Sustainability partners.
Yes, I'm sorry.
How does it differ? Well, maybe I should describe what sustainability partners is. Nonie, you're familiar, right?
Sure.
So it's essentially infrastructure finance as well, but it's the scenario there is you have the company that actually is responsible for the procurement. So they provide the capital, they procure the assets, they install the assets, and they maintain the assets, right? And the customer, and it's generally a durable entity like the government, hospital, et cetera. They essentially pay for the utilization of the asset. So they pay for vehicle miles, they pay for unit of energy produced, they pay for wastewater volume treated, whatever that is. So that's very different from what we're seeing here. And also the scope that we're talking about is it doesn't overlap at all. So you have durable entities like these university systems, hospital systems, government entities versus commercial properties, right? Industrials, hotels, retail that Nonie you mentioned. So it's two different scopes, but the source of the capital might overlap. So it could be insurance companies, banks, pensions, sovereigns, etc. Does that make sense?
Yeah. Thank you.
Okay. Mitch, you have your hand up?
Yeah, I do. Hey, thanks a lot, Nonie. This is fascinating stuff. My understanding is, does this have to? Can this go just by county, or do all the counties have to buy into this in the state before the state is eligible?
County by county. The state is already eligible. Now every county has to raise their hand and say, "I'll pass an ordinance. It's good in my county." So Big Island could, Maui doesn't want to. Big Island would get it.
Okay. Thanks.
Mm-hmm.
Is there any reason why a county wouldn't want it?
Well, that's what I want to know. I will again. We've only been at this for a month now in terms of educating the counties. I'll say that initially Gwen went about it through educating the directors of finance and the administration. As you can imagine, they might think of this as extra work, even though HGIA is going to do all the extra work, right? But it's just something that they need to think about and do, and they're all busy. So, so from that perspective, what does the director of finance department actually get out of it? Maybe nothing, right? In terms of they're not getting money in, although they're not expending any energy out either. They're not expending resources. Mm-hmm. So it's a matter of educating. So when we've gone to the council members, they see it globally as helping the county. So we've got a lot of great uptake from the council members. Where we might get slow action is through the administration. But that is, slowly changing. It's really a matter of education that there's no risk to the county. There's no resources required by the county.
So the benefit really accrues to the elected officials' constituency versus the
county
bureaucracy.
Right. Exactly.
Okay, and that's a good thing.
Economic development.
Oh, economic development. I mean, like I said, that affordable housing developer, he's like, I'm not going to build the project if I can't get CPACE. So $200 million, he's got two $200 million projects that are going to create jobs.
Ray has his hand up.
Yeah.
Yes, sir. So do you have a list of counties that have already signed on?
Well, we just started this about 3 weeks ago, but I've got commitments from Maui, Kauai, and the Big Island.
Excellent.
To put in ordinance bills. Honolulu is, the people that we've talked to are very interested in it. And we're talking to the administration. So I think it's just a matter of time. They're just a little bit slower in terms of the conversations. but the ones that we've talked to on the other 3 counties are definitely wanting to do this, and in fact they're saying we want to be first, so they're trying to compete with the other counties.
Thank you. That's outstanding.
Nonie, do you see an opportunity here, or based on your experience with the entities you work with here, commercial property owners, do you see an opportunity to put a spotlight on what CPACE can do, but also that in conjunction with all of the other incentives, be it the IRA, the tax credits, the IJA. There's so many different incentives out there that you can marry together with the opportunity to get this loan or this access to this capital. And I guess I'm just wondering if someone is looking out for that, or if it's up to the property owner or the entity to know that, and therefore they just need to let or let the organization or the facilitator know, or the bank know how much they need. So is there someone or an entity that's guiding a business owner or property owner around how to leverage all of these different instruments to effect something in their business?
Sounds like a new business model to me, Noel.
Okay.
No.
Okay.
No, I mean it's, the financier, the property owner is going to go to the financier and say, I want to borrow this. But you're absolutely right, with IRA and IJA, all the tax incentives that are available. I mean, it's like the perfect storm. And this good, easy money that can be gotten, right? Now's the time to do it. Yeah.
Okay.
So I estimate, based on my conversations, that we might see a potential bill go through your county around the end of August or beginning of September. And I would love to get your support when it enters the process for testimony, telling your council members if you agree. I hope you guys agree that this is a pretty good tool for your businesses there.
There was something you said in your presentation earlier, pardon me for interrupting, and that is it's hard to describe this, but this is a mechanism by which we allow for money outside of Hawaii, potentially, quite a bit of it, to actually affect public benefit in Hawaii, right? Create jobs, create energy efficiency, create all this stuff. Again, using capital that exists elsewhere. So this is a way to funnel money into the economy and create all these potential benefits. So I think there's some important messaging here that we need to get out so that people can appreciate that and the overall benefits of this program. Happy to communicate that.
Thank you. Well, and that's the other thing too. If you could help me understand who else I should be presenting to, who else Gwen and I should be presenting to, because we really want to build the stakeholders. And also, as you can see, this is something that's not well known here in Hawaii. It's very well known on the mainland, but it's a whole new concept. And because there's so much good, people are like, wait, I don't understand. How can this happen when the county's not on the hook, and the commercial entity can benefit from this, and you can lower your operating costs? It's real, it's being done, and we just need to educate more people. So if there's other stakeholders that you can suggest that we can present to, we would love to.
The chambers would be good. The chambers of commerce.
Yeah, I've reached out to Miles. I've reached out to Benson.
Okay.
Would out of country, say Canadian banks be something that you would want to speak to, or is that outside the scope of this program?
They would be financiers. Is that what you're saying?
Yes.
Yeah. So my mission is to educate the counties. If there are CPACE lenders that are authorized to do business here, by all means, you can utilize them.
I was thinking to introduce it to some of these entities that might not be familiar with the program.
Oh, that's not my scope. Sorry.
Okay.
So one last question about as far as presenting it to the county council for approval. So far, you have not encountered any argument against the county engaging or approving this type of a program. I mean, have you heard anybody articulate a reason to oppose it?
I would anticipate, based upon our endeavors last year during the legislature, that a couple of local banks might oppose it.
Okay.
I mean, as Noel said, it is outside capital coming into Hawaii.
Right.
And so perhaps, they would want to oppose that, right? But they can do it too. They should see it as an opportunity for another line of business.
Mm-hmm.
So that's where I see potentially where there might be some pushback. I have done presentations to some council members who say, I only want to limit this to public good buildings and not to hotels or other commercial buildings. And my comeback to that is that what you're enabling is public good infrastructure, right? So why would you want to limit it to just affordable housing? And the more competition you can have coming in, so the more third-party financiers who see opportunity here, you're going to drive those rates down for you guys, right? So by limiting the type of commercial property, I don't think that's a good idea.
Yeah.
The market will decide.
From my understanding, for instance, something like the hotel sector on the Big Island consumes maybe 5 million gallons of water a day. So if that consumption can be made more efficient and they can maintain their same, their same client load, but use less water, that's a benefit for everyone.
Exactly.
Okay.
Exactly. Right.
All right.
So Nonie,
I think
you did say first right of refusal would be the banks.
Yeah, they have to give lender consent, which allows them first right of refusal, basically, right? Or they can refuse it totally and say, I don't want you to have a CPACE loan, period.
So you're referring to the existing lien holders on any particular property?
Right.
Okay.
Right. Of which the majority of the commercial lien holders are not from Hawaii. They're not local banks.
You think that
Right.
a utility co-op on Kauai would qualify for your CPACE program?
Typically, I know for HECO, they don't pay property tax. So I don't know if Kauai pays property tax. So for HECO, they wouldn't qualify.
I would think they do because they're a co-op.
Yeah, I'm not sure of the tax structure there.
They might be able to benefit from your program. You've been doing this program in California for quite some time, haven't you?
The program has, yes.
I think you made a presentation to me at not maybe you, but at Amgen, a biotech company in California.
So can you guys see where this might be useful in your community?
Oh yeah.
Yeah, absolutely.
Great.
Ray, you have your hand up. Is that from earlier, or do you have another question? You're muted as well.
Okay. Sorry about that. Yeah, I don't know how to take it back down.
Okay, that's okay. Yeah, we're a little over time here. So, any other questions from anyone? And also, if no questions, anything brief that someone would like to raise?
This has been great. This has been really informative. I love this.
Wonderful. Well, if you need my contact number, I'll send it to Jerry. Jerry has it. If you have individual questions on some projects that you might be looking at, I'd love to put you together with one or two of the CPACE lenders so you can get more specific information and you can provide other scenarios. I'm glad that Riley was on the call because I do need to get the administration to embrace this, and I have not had the opportunity to talk to them about it, to talk to Riley or Doug or the mayor. But again, Deanna, the finance director, does seem to want to move forward with it, so she's reviewing the potential statute, the potential bill, and putting the corporation council's edits to it.
Is the language of the statute that has to be submitted to the county, and then that'll be made public, and in due course we will have the opportunity to offer testimony and support.
Yes, yes.
So that
and,
okay.
And so whatever communication mechanism you tell me, I can shoot out, okay, Bill's going to enter into the process. I can forward to you all a copy of my presentation. I can forward a copy of the state statute, which allows this, right? And then the counties are looking at a draft of the potential county statute. And let me know if there's anything else that I can provide you.
Well, good luck, Nonie. That's a lot of work. You got to go to 4 counties.
Yes, thank you. So if any of you have any ways to tap into your administration and say, hey, you need to talk to Nonie and Gwen, I would appreciate it a lot.
Okay.
Okay.
Excellent.
Thank you, guys. Okay.
Thank you. Have a
I'll
great
sign
evening. Everybody, aloha.
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 Thanks.
Thank you.
All right.